since I kind of discovered that everything code thesis about liquidity being the dominant driver, I realized there's one macro driver that drives everything. And then on top of it is the adoption of technology, whether it's crypto or tech. Those are the two mega trends. Nothing else outperforms the debasement of currency, which is 8% a year plus 3% inflation. So 11% a year is what you need to do to break even on your savings. And so you've only got two assets to do it, technology and crypto. When I divide the NASDAQ by Bitcoin, it's down 99.97% since 2012. Every time horizon, it's underperformed, but they're driven by the same factor.
In today's financial world, one unseen force quietly shapes the direction of markets, economies, and investor behavior: liquidity. It's not company earnings, economic data, or political events that move markets the most. It's how much money is flowing through the system. When liquidity is rising, it boosts nearly everything. Stocks climb, credit becomes easier to access, and riskier assets like cryptocurrencies often rally. But when liquidity dries up, markets can fall quickly. Understanding this flow of capital isn't just useful, it's crucial. Few people grasp this better than macro investor Raoul Pal, who argues that we're not just in a different market environment. We're entering an entirely new era he calls the exponential age. Pal defines the exponential age as a time of rapid technological growth that's transforming markets, behavior, and how wealth is created. This change isn't gradual or predictable. It follows an exponential curve, meaning it accelerates faster over time. Technologies like artificial intelligence, robotics, cryptocurrencies, biotechnology, and clean energy aren't just improving. They're improving at an increasingly faster rate. According to Pal, our old ways of measuring value, like traditional investing models or government policies, can't keep up with this pace of change. These tools were designed for a slower, more linear world. Traditional assets like bonds or blue-chip stocks often lag behind in this new age. That's why Pal focuses on what he calls exponential assets, things like Bitcoin, Ethereum, and other emerging technologies. These assets have network effects, meaning their value grows as more people use them, and they offer asymmetric returns, where the potential upside far outweighs the downside. Unlike traditional investments, exponential assets don't rely on steady profits or dividends. Their value is based on how quickly they're adopted, how scarce they are, and how much global liquidity is available. In other words, they thrive in environments shaped by fast growth and easy money. Pal breaks down these concepts in a recent interview with Mohammed Rasool, CEO of Amana. As we bring you clips from the interview, please share and like this video, subscribe to the channel, and turn on post notifications for more insightful analysis from the industry's brightest minds. Thanks, and enjoy the video.
To explain the exponential age, it's this extreme exponential adoption of these technologies, whether it's AI, whether it's crypto, whether it's EV, whether it's robotics, whether it's space, all of these things. And they are all on a log return. So they're exponential. If you look at price charts. So that is the game we're playing. Those exponential assets, if you think of Amazon stock, back in the early 2000s, it fell 97%, it went up 600%, it fell 50%, they're volatile.
Yeah.
So they're volatile assets, but if you can hold on to them, the returns are truly extraordinary. This is why Jeff Bezos is the richest man in the world, or close to it. And, it's all the same thing. So that is the mega trend. That's the exponential age. Within it, you have the business cycle and the liquidity cycle that drives this. So what you find is you need to understand where you are in that cycle. That cycle is driven by liquidity flows, let's say. And recently, we had liquidity tightening from a strong dollar and higher rates in Q4 2024. That has a 12-week lead into assets. So assets fell because liquidity had tightened then. Liquidity has been doing the opposite now. It's been easing massively. And so price should follow. But the volatility is big, right? People don't realize is, you're used to a 10% being a correction in the S&P and anything above 20% is a bear market. 20% is an afternoon in crypto because it's highly volatile. It's a 70 vol asset versus a 15 vol asset. So it's much more volatile. So the idea is you need to be able to understand how to navigate the volatility. So what we call the banana zone, what is that? That's the accelerated point in the cycle where prices go exponential. It's usually at the latter point of the business cycle. And that's the kind of zone we started. We had the big leg up Q4 last year. We've had a corrective period, and then usually we now should go up for the rest of the year in a way that makes it quite hard to even buy, with a couple of sharp corrections en route just to gut check everything.
Yeah. With the unknowns that'll come in through.
So now we've established that we're in this exponential trend that is driven by the business cycle. It's a 4-year cycle driven by the debt refi cycle. We're in the last year of that, which is usually one of the best parts of the entire cycle. It is going to be volatile throughout that period. So then my job is trying to communicate to people, okay, if you've been given the greatest performing asset of all time, then you don't want to screw it up.
Yeah.
And it's hard because most people aren't used to volatility. It becomes emotion. And emotion doesn't help you in this. It'll force you to do the wrong things. So I try and explain to people, firstly, don't use leverage. It always looks great because you see some guy on Twitter who's made 100x returns and he's done it in perps and he's done it. It's like, it's never going to happen. You are going to lose your money. Because rule number 1 is don't lose control of your tokens. Because really, you want to hold it from here and you want to be Jeff Bezos here. Right? And he didn't lose control of his equity. You don't lose control of your tokens. So that's really vital. It's also, don't FOMO, because you'll find out you'll end up buying at peaks and selling at troughs. That's the emotional side of things. Also expect 30 to 40% pullbacks often and think of them as normal. And if you've got cash, that's when you buy more stuff. So it's like having this mentality. It's also be careful not to lose your tokens because you get hacked. So store them on a ledger system somewhere.
Yeah.
Keep a cold wallet. Just simple things like that will stop you losing your tokens. Stop you, even you FOMOing in fear, selling out, panicking, or bull market buying too much. If you don't do that, you'll lose control of your tokens. Again, just don't lose your tokens.
The basics.
And hold it from here. And in 5 years' time, it'll be here. And in 10 years' time, it'll be here. And people don't believe that's possible. But this is the gift that keeps on giving it. It's the same with NASDAQ.
Yeah.
Right? Tomorrow will be more digital than today. It's a simple fact. So will tech stocks over time do well? And everyone goes, yeah, but they crashed in 2000.
Right.
Okay, well, we had a massive bubble in tech stocks then. You pay back for a year or two, but anything you bought into that crash was Amazon, Google, Apple, all of these things did stunningly well. So people just have the fear of what's happened in the past. But we know this tech adoption curve is not going to stop. In fact, it's increasing. So the probability is, even if you have a bear market, which we had in 2022, it lasted 1 year, 9 months. 9 months, it bottomed out with liquidity, and it's been up ever since.
Raoul Pal challenges the traditional notion of asset diversification, especially in the context of the macro and technological shifts unfolding in what he calls the exponential age. While classic investment theory champions diversification across stocks, bonds, real estate, and commodities as a way to manage risk, Pal argues that this approach is increasingly outdated in a world where everything is becoming more correlated to global liquidity. He believes that most traditional assets now behave similarly during periods of monetary expansion or contraction. When central banks inject liquidity, nearly all asset classes rise together: stocks, bonds, real estate, and even art. And when liquidity tightens, they all fall. This correlation breaks the fundamental promise of traditional diversification, that when one asset class zigs, another will zag. In Pal's view, diversification in today's environment is not about owning different types of assets. It's about owning assets that behave differently across liquidity regimes. This is where he sees exponential assets like Bitcoin and Ethereum playing a critical role. For Pal, crypto is not just another risk asset. It represents a new asset class entirely, one with unique reflexivity, adoption-driven growth, and structural scarcity. He has publicly stated that he is personally, irresponsibly long crypto, not because he rejects diversification outright, but because he believes that over the long term, these assets offer asymmetric upside that traditional assets simply can't match. They are not just uncorrelated in terms of volatility, they are structurally different in how they gain value. With that foundation in place, let's return to the conversation and explore how Pal's views on diversification are being tested in today's markets.
I'm the wrong person to talk to about diversification because I've run large diversified portfolios, big hedge fund portfolios with many, many positions. And what I found is, since I kind of discovered that everything code thesis about liquidity being the dominant driver, I realized there's one macro driver that drives everything. And then on top of it is the adoption of technology, whether it's crypto or tech. Those are the two mega trends. Nothing else outperforms the debasement of currency, which is 8% a year plus 3% inflation. So 11% a year is what you need to do to break even on your savings. And so you've only got two assets to do it, technology and crypto. When I divide the NASDAQ by Bitcoin, it's down 99.97% since 2012. On every time horizon, it's underperformed. But they're driven by the same factor. 97.5% of the price moves of the NASDAQ are explained by global liquidity and 90% of Bitcoin. Yet, the performance is so wildly different. So I don't even own any tech stocks. Yes, I have trade recommendations for people who do, etc. I don't own those. So now you've got the world of crypto. So then, if they're all being driven by the same thing, what you want to choose is the fastest horse. Now, that's not buying the meme coin that can go up 100x. What you're trying to do is look for what are meaningful projects being run by meaningful people with meaningful communities. So it's this Metcalfe's law idea, how many active users do they have? What kind of value are they creating?
The utility, if you will.
Yeah, it's the measurement of the entire utility of the network. Do people value the network? Do they want to build on it? Do they want to transact on it? Do they want to own it? And so there's not that many that really show this. You've seen some of the communities like Cardano has a huge amount of retail users, almost no applications. Bitcoin has both at scale. Ethereum has both at scale. Solana is earlier in the network adoption model, but it's got it at scale. Sui, arguably, very early, looks like it might get it. So then I played the dumb idiot. I kind of have a thesis in my head, and I'm just like, what does the chart look like? And so you start with the chart of Bitcoin. That's your benchmark. Is the asset that you think is the greatest asset ever conceived, the one that you want to own, is it outperforming Bitcoin or not? 99% of all tokens don't. Okay, don't own them. But once you find the one that looks like it will, okay, now it's interesting. And that's what I had. That's why I switched from Bitcoin to Ethereum in the last cycle, then from Ethereum to Solana this cycle. Solana outperformed Bitcoin and outperformed Ethereum. And then halfway through the cycle, I realized the other horse in the race was going to be Sui, which was the ex-Facebook team built a blockchain, and I happened to be on the board of it, but it wasn't for that. It's because it was breaking out versus Solana, which was easily the strongest horse. I'm like, okay, this is the strongest horse squared. This is my bet.
Nice, interesting.
And so I'm pragmatic because, as you say, we don't know what will survive and what will do well. So I'm just pragmatically looking at kind of weekly chart time horizons.
Performance quite a bit.
Is it breaking properly? Have I got something to capture in understanding how it's going to move going forwards? I'm not interested in day by day stuff. Is it structurally looking like it's going to outperform? If it is, I'm going to hyper concentrate because then I don't have to worry about anything else.
Meanwhile, Bitcoin is making headlines again, this time with a bold new prediction from one of the world's major banks. Standard Chartered, a leading global bank based in London, has just released research showing that interest in Bitcoin is spreading across a broader range of institutional investors. This insight comes from recently filed 13F documents, quarterly reports that large investment firms in the US are legally required to submit if they manage over $100 million in assets. These filings, made public by the U.S. Securities and Exchange Commission, reveal what major institutions, like pension funds and asset managers, are putting their money into. And according to Standard Chartered, more of them are now gaining exposure to Bitcoin indirectly by investing in MicroStrategy stock. MicroStrategy is known for holding massive amounts of Bitcoin on its balance sheet, making its stock a popular alternative for those who want Bitcoin exposure without directly buying the cryptocurrency. In the past, most institutions preferred buying into BlackRock's iShares Bitcoin Trust, a spot Bitcoin ETF, for this kind of exposure. But during the first quarter of 2025, interest in that ETF cooled off, while demand for MicroStrategy surged. This shift in strategy has led Standard Chartered to double down on a bold forecast: a $500,000 Bitcoin price by January 2029. The bank believes that as more institutions gain access to Bitcoin and its price becomes less volatile, investment portfolios will gradually increase their exposure, moving from an underweight position to what Standard Chartered calls an optimal level. The latest SEC data supports our core thesis that Bitcoin will reach $500,000 before President Trump's second term ends, the bank stated in its report. At the time of this report, Bitcoin is showing modest upward movement. It's trading just above $110,000, reflecting a 5% daily gain and a 10% rise over the past week, according to CoinMarketCap. Bitcoin's total market value now stands at around $2.21 trillion, with a small 0.56% increase in market cap. Bitcoin's dominance over the entire crypto market has grown slightly to 64.05%, suggesting that investors are shifting capital back into Bitcoin, even in quieter market conditions. Futures markets also reflect cautious optimism. Open interest, the total amount of outstanding futures contracts, rose slightly to $71.2 billion, indicating steady, though careful, trader engagement. Interestingly, most of the liquidations in the past 24 hours came from short positions, bets that Bitcoin's price would fall. According to data from CoinGlass, out of $1.53 million in liquidations, $1.52 million were short positions, meaning bearish traders were caught on the wrong side of the price action. With institutional interest expanding and price action remaining relatively stable, Standard Chartered's long-term view offers a compelling narrative. As adoption grows and volatility shrinks, Bitcoin could climb to unimaginable heights. Whether or not we hit that $500,000 target, one thing is clear: Bitcoin is no longer just a retail investor's asset. Wall Street is paying attention. Drop your thoughts in the comments. Do you think Bitcoin can hit $500,000? Or is Wall Street getting ahead of itself? If you found this breakdown helpful, don't forget to like, subscribe, and turn on notifications. We're diving deep into the trends shaping our financial future every week. Whether you're a seasoned investor or just curious about where the world is heading, this is the place to stay ahead.